This is Advisor 3.0, a show designed to help you as a financial advisor elevate your professional practice, transform your clients' lives, and take your business to the next level. I am Abraham Okusoya. Welcome to the show. Welcome to the show, ladies and gentlemen. Over the last decade or so, we've seen a massive influx of capital into the financial advice and the wealth management side of things. A lot of this money is coming, of course, from private equity, backing large advice consolidators, and also in platforms. Lately, we've started to see venture capital flow into advice space, backing technology firms that are creating solutions for financial advisors. My guest today is at the forefront of this development, is none other than Loic Fonteneau, who is the investment director at BlackFin Capital Partners. BlackFin, of course, many of you might know, led, Timeline's Series B round, and Loic led the round. So Loic has joined me on this episode of the show to unpack what's going on in this space. Loic, welcome to the show.
Thank you, Abraham. Pleasure to sit down virtually with you for this conversation. I know that your podcast is well followed and it's a good source of knowledge for advisors and people interested in industry. So hopefully they'll bear with my French accent and they will find this episode informative as well.
Well, if they can tolerate my accent, I bet they will have no problems at all with the French accent. But let's talk about you. You know, when I was in Paris a couple of days ago, and one of your colleagues said to me, "Loic is British now. We don't think he's no longer French. So you're a dual citizen." But let's talk about the background story about your career as a VC and how you came to join BlackFin.
Yes, certainly. So, well, actually, my journey to the world of VC has not been so straightforward. So I was born and brought up in the splendid city of Paris that you know well now. My parents at the time actually were working for the French army. And although I went myself to a military boarding school, I realized quickly that it was not what I wanted to do. I was more interested in business, in innovation, in international development. So I ended up studying both engineering and finance. And I landed a job in M&A at JP Morgan in London, covering what we call financial institution clients. So it was back in 2007. And my clients were big banks, insurers, asset managers, names that you may recognize like BNP, UBS, AXA. So quite a lot, obviously, in the French and Benelux region, given my background, and also from time to time in Switzerland. But it was back in, as I said, in 07, 08, pre-Brexit. So most large American banks, they had their hubs in London. And that's where I was based, and I would fly, to like the various cities across Europe to pitch ideas to clients or to work on M&A or IPO mandates. At the time, there was no really like Zoom or Teams, and then you would not do really things over the phone. It was not really acceptable. But obviously, when you're young and you're starting your career, you get to fly, business across Europe. You're staying in nice hotels. That seems pretty cool. And after a while, you realize that it's super inefficient. And at the time you spend going to the airport on the plane, well, that needs to be taken away from your own sleep because the workload doesn't stop. So I think these days, fortunately, it's a bit more sensible in this industry. But for those who are old enough to remember as well, so 07, 08 was the start of the great financial crisis. And actually, I was a bit in the middle of that, and it was pretty interesting to be working with financial institutions at the time because you had to solve like very, very complex issues for them. There was a ton of analysis to be done around like bad loans, questionable balance sheets, weakly capitalized banks. So as a young professional, I was working also with like very experienced executives, sometimes with governments. So despite all the stress, of the investment banking long hours, I felt like I was really learning a lot, and I think that kept me going. So I stayed in that team for about 8 years. And then I changed team, still within JP Morgan, to a team called Technology Investment Banking, this time covering clients in the technology sector, again, helping them to do M&A, IPO, various capital raising. And there was clients in the space of fintech, software, or technology services. And it was also very interesting at the time. So it was around 15, 16. It was a bit the emergence of the tech scene in Europe. And so the dynamic was quite different compared to my previous days in the financial institution sector, where my first experience, it was to help clients manage non-core assets, manage costs, whereas for most of these tech clients, it was more about like, how can we help them grow, how can we help them expand, and where can they find the next M&A target or funds to do that. So very interesting experience as well. So I stayed in that team for about 5 years. And then after a while, I was approached by BlackFin, which was a company which I knew on the private equity side. They had launched a VC fund dedicated to fintech. They had a team of 7-8 people to cover that strategy, but they wanted to continue expanding and opening an office in London, which is where I was based, and where obviously the main fintech hub is located in Europe. So we had some discussions, and we quickly found that it was a good mutual fit because, I'm a French guy, but I'm based in London. I'm familiar with the local market. I had a network here, the relevant experience, both with financial institutions and technology clients. So, and I knew them. I knew they were very serious and committed to the space. They were not in fintech because it was a trendy, but they are real insights, credibility, and long-term commitment in the space. So that convinced me to jump ship. It was in April 2021, so a bit more than 2 years ago now. And yeah, the rest is history, as they say.
The rest is history. So you came over to BlackFin. Let's talk about BlackFin itself. I am still, obviously learning about the company. So tell us a little bit about BlackFin. Give us a brief history of the firm and high level what the business looks like today.
Yeah, absolutely. So BlackFin is a private equity and venture capital investment firm, which is fully focused on backing companies in the financial sector and fintech. It's owned by its 4 founding partners, so Laurent Bouilloux, Paul Mizrahi, Eric May, and Bruno Rostin. And we have a bit more of 40 people now across 5 offices across Europe. So the headquarters are in Paris, but we've got people in Brussels, in Frankfurt, in London, obviously, and in Amsterdam. So we're really like pan-European, and our model is multi-local. So we are present in the markets where we invest. And BlackFin was started around 2009, 2010 by these 4 founders. They knew each other very well because in the late 90s, they had launched an online broker in France under the name of Fonteneau. So a company which was quite similar to like an AJ Bell in the UK. And obviously people are quite familiar with the D2C side of these businesses. But Fonteneau was actually more successful as a B2B company, being a white label provider of front-to-back solutions to many French institutions. So it's been quite successful. In 2006, they sold that business to Crédit Mutuel Arkéa, one large incumbent in France. And on the back of this success, they decided to create BlackFin to capitalize really on their experience as operators and experts in financial services. So today, we've got these two strategies. So private equity on one side, where we manage about 3 billion. And in 2017, the team decided to launch a venture capital strategy with a separate investment team and dedicated funds, obviously. And so here we manage about 600 million across two funds.
Incredible stuff. And I met some of the founders, Laurent and Paul, a few days ago. I was really taken by their just how down to earth these guys are. They build this incredible business, that you are now part of. So great to get a give our audience a sense of that history. So you're on the uh, venture capital side, which is known as BlackFinTech. Let's talk about that business. Let's talk about the two funds that you have, and then maybe we can then dive into the investment strategy. As I understand it, BlackFinTech in particular is fintech focused. So let's dive into that aspect of the business.
Absolutely. So on the VC side, indeed, we have two funds. So the fund one was launched in 2017 with a size of 180 million. It's been fully invested to date across 17 businesses. We made initial tickets between 5 and 10 million. And given the ticket size, it was a fund geared towards what we call late seed or Series A companies. And now that this fund is fully deployed, we are investing now out of Fund 2, which was launched last year, so summer 22. And that fund has a size of 400 million, so more than double the first one. And the idea is to deploy this time tickets between 5 million and 30 million with a sweet spot, again, for companies at Series A and up to Series C stage. So in terms of our strategy, first we target, as I said, fintech companies, which are really trying to disrupt their market with technology. So it can be in the banking space, in insurance, in wealth management, like yourself, or in RegTech, for example. Then we have a clear focus on capital-light business models. So things which are software-based, commission-based, or payment companies. So generally, we don't do lending, we don't take balance sheet risk. So we try to avoid this sort of business models. Then we have a strong bias towards what we call B2B business models. So selling to financial institutions, SMEs, independent professional workers, but not really like to the retail clients, where we feel that differentiation is often quite limited. So that's a little bit the strategy of the fund. And our LPs or investors, without giving you like some exact names, include themselves like banks, insurers, or pension funds or endowments. They are like multi-international, pan-European, and some of them from North America. They know that disruption is coming to the financial sector. They want to not participate to it, but benefit from that. And so it's a way also for them to learn through our work and through the investment that we make to follow what we do and to also be able to follow this disruption.
Thanks, Loic. So let's the number of times I have met a financial advisor since we announced the timeline deal, and they'll say to me, "Oh, Abraham, you now have private equity for investment in your business," and I would say, "Oh, no, we're venture. This is a VC," and they would say, "No, it's a private." So I quickly figured out that it's a maybe pointless to try to explain the difference. So a good idea then is, well, I'll just get you to do it. I'll just so talk to our audience. I think you're uniquely placed to do this, about this difference between private equity generally and venture capital.
Yeah, certainly, indeed, because we have the two strategies in house. We can see clearly like the two difference, the two aspects which are very different between the two strategies. So both private equity and venture capital, I mean, it's about investing in private companies, as people can figure out. But there's a couple of like really major differences, and I think the first one you need to have in mind, it's the type of transaction. Because PE funds will typically look to take a majority ownership or even like a full ownership of the companies they invest in. It means that they will have full control, really, in terms of the decision making, the strategy. They would put in place their own management team, to execute the strategy they have in mind. Founders usually will exit or only retain, a minor role going forward, and really like the PE team will be in charge of setting the strategy. VCs, on the other hand, will look to make minority investments in a business, for example, taking 10% or up to 30%, and really are looking to partner with the existing founders and sometimes existing investors who came before them, but without obviously replacing them. So they will have some rights, which will be commensurate with the investment that they've done in the company. They will be able to influence the decision making and the strategy through the work at the board level, or through advice to the management. But typically, the management team or the founders will retain control, and they will retain for sure like the day-to-day business operations. So really, like the difference between the two is, when you sell to a private equity, it's really like you say a bit goodbye to your business. Whereas venture capital, you enter into a long-term marriage where it's about a partnership. And you would do that because obviously you need to raise fund to continue expanding on your business, and certainly you have growth ambition as a founder, and the VC team will be there to help you execute, providing these funds and providing advice also going forward. I think another major difference between the two types of strategies is the type of companies they work with. So the PE funds generally will target very mature companies with established businesses, not necessarily growing fast, generally profitable. And so the way they will make money is if they can generate some operational improvements or improve margins, for example. They can use leverage as well to boost their returns, but they will not fundamentally change like the way the business operates unless something is broken. VC, on the other hand, they would generally target early stage startups that have very high potential for growth, but that are still quite a risky proposition because they are trying to innovate with a new technology or new product, and they are still relatively small compared to some of the actors in their market. So most of the VC-backed companies are loss-making because they're really focused on developing a product and really focused on growth. And so in that case, VCs will aim to make money ultimately if they manage to make the company become really relevant and become like a really strong force within the industry. And some example that you can think of, it's like a Stripe or Revolut, for example. So these are like, I think, two major differences between these strategies, and I think things that you have to keep in mind when you're trying to compare both. In specific case, I would say with the collaboration between Timeline and BlackFin, it's clearly the VC team, as you said, that invested in Timeline, that got involved. So we led your Series B. It was a 10 million round. we took a minority stake in a business in exchange for additional capital, which will help the company grow further. So it's super important again to note that the VC model is a partnership. The company, the management team is still independent. Yourself, Abraham, remain the CEO. Ultimately, you remain in charge of the day-to-day business and the strategy. Now, obviously, we are one of your shareholder, but our interests are aligned because we are both want to make this company a success.
Well, thank you for saying that. By the way, like I like the clarity, that you come, that you bring to this, because my explanation of this would have been very, very clumsy. Actually, the clarity in terms of ownership, well, in terms of control and the type of the business. Can you just talk a little bit about leverage? In the PE side of things, I am assuming that the typical approach, correct me if I'm wrong, and please feel free to tell my listeners what nonsense I am talking about. But the way I thought about it is like in the private equity side of things, generally, they're putting up 20% of the capital and borrowing 80 to make the acquisition, to buy the business. And there's a lot of debt in that equation, which comes with its own challenges. But VCs, for the most part, there are exceptions, but for the most part, tend, at least in the fund structure, tend to avoid the use of leverage. Tell me I'm wrong, please.
That's absolutely correct. PE companies are able to, be acquired for a mix of equity and debt because inherently they are profitable businesses which are able to service this debt level. And yeah, the level of debt really depends on the companies. I wouldn't say it's 20/80, it's probably closer to 50/50, but it really depends on the case. But fundamentally, they generate cash flows and they are able to use these cash flows to repay debt. So they are able to use this leverage. On the other hand, on the VC side, as I say, like most of the companies that we invest in or that the other investors invest in, these companies are still loss-making. So in theory, some lenders, some funds would be okay, to finance the investment partially with debt. However, it's very, very risky proposition because you need to service that debt even when you don't have the monthly cash flow to support it. And so at some stage, the business can run into very big trouble. And maybe some of the cash that you've raised, you will ultimately fully use that to repay the service of that debt. So I don't think fundamentally using debt or leverage in venture capital type of companies is the right strategy.
Good stuff. Thank you. So let's break down the maths of VC investing for me, from the perspective of the VC firm or this VC fund. So for every company you invest in, how many of them do you expect to break out and be an outstanding success? How many would you expect to break even? And how many would you expect to fail? How does this stack up, from a numbers point of view?
What we expect is that none of them will fail and all of them will be home runs. What we have to live with, however, is reality. And so it's true that, fundamentally, VC investments are high risk in nature because you invest in early stage companies, which are still in the phase of their development. So maybe what I can give you is a bit of what we can observe, in the industry. It's like there is this rule which people call the power law, which says that there is only a few successful investment that would generate the majority of the returns of your fund. So maybe if you invest in let's say 10 companies, You will have one or two, where you will make a return of 10x or more. Then you will have like two to four or 2 to 5, which will return between maybe 1 times up to 3 times. So like okay return, but not fantastic. And then the rest of it, so 50% or more, will fail to return anything or below one. So I think that's more or less what the industry is experiencing, on an average. But it's mostly true as well when you look at the very early stage. And I think the further you go towards the later stage and towards the P side of things, the more consistent the portfolio will be, at least in terms of companies' performance, and the less failure or companies closure you will have in your portfolio, because obviously more mature companies will hopefully get to a stage where they can be profitable, and so you won't have any failure in your portfolio. So I can't give you like the exact breakdown of our own portfolio, but as I say, like when we invest, we expect all of our companies to make a very good return. Otherwise, we will not invest. And I would say that at BlackFin, our returns are much more consistent than the industry average, which I think is a function of the specialization towards the fintech sector, and to the fact as well that our investment strategy has been very focused on what we know, i.e. business models on the B2B space, capital light, which we think are much more resilient over time, especially as we are experiencing some downturn in the last few months.
And speaking about that strategy, then the broad approach is to now. I mean, your fund two is going across stages, kind of from Series A to D, I assume. And so the idea is that you invest, you write the first check for these companies, and generally you expect to follow on, keep some sort of reserve. To talk a little bit about why and the framework around that.
So I think the fund indeed is able, because of its size, to be involved across multiple stage. We will look to come relatively early, but as I say, it's sweet spot between Series A to Series C. What we want to do is to generally maintain a strong ownership in the companies where we invest. Typically, VC-backed company will undergo like different funding rounds, maybe 2 or 3 over its life, and so for us, like coming in early and being able to reinvest as part of a potential next round will enable us basically to keep the same sort of ownership that we had initially. And I think it's very important as well, because as the company grows, as the fundraise increase, you get diluted little by little, and ultimately when there's an exit event, you will lose some of the returns that you could have made if you had followed on all the way up, I would say. So that's a little bit how we think about it on the mathematical terms. The way also we approach this thing is we are fundamentally believers in the businesses where we invest, and for us, it's as I say, it's a long-term marriage. So we know from the get-go that we will have to invest generally in a company multiple times. So we sort of reserve like some of our allocations on each company when we start to invest to make sure that we have enough to back them in the following rounds.
Good stuff. Just by the way, just you mentioned the power law there. For anyone, any of our listeners who's interested in digging deeper into this, there's a book I read this two odd years ago, I think, or maybe last year, I can't remember. Called "The Power Law: Venture Capital and the Art of Disruption" by Sebastian Malaby, very, very good book. I really learned loads as I went through this journey of building a company and raising venture capital fund. So I will highly recommend it. But coming back, so Loic, again, thank you just for the clarity and the wisdom. Um, so you open a door there and I want to go in, so talk about why you invested specifically into timeline, maybe as part of your, I mean, you've already told us a little bit about your overall approach to investing, but talk a little bit about timeline. Why, and how does this align with your overall thesis of investing?
Yeah, absolutely. So obviously, we're very excited to about our investment in Timeline because we believe, like yourself, I think that advisors fundamentally serve a very important role in this market, especially for segment of people who have a certain wealth or approaching retirement. I would say that certainly, for the more retail side of things, like a more automated approach or some robo advisors may have some merit. But when it comes really to estate planning, tax, inheritance, we feel that people want to be able to speak to someone they can trust, someone they can feel, and who look like them, not just like a robot on your phone. Um, However, so I think the advisors are critical to manage their clients and this client's relationship. But I think that clearly there's some things that they can do to improve the way they work. And we believe that fundamentally using technology can help them to be more efficient, to serve more clients. They can use technology to provide these clients a more digital experience. And also they can use technology to be more consistent and more complete in the way that they advise their client about things. So when I'm thinking about this, looking at the investment also and the portfolio allocation, we are big believers that passive instruments are really very useful to build solid, cost-effective, and diversified portfolio. So what we found in Timeline was basically like a compelling proposition based on technology, which really serve the needs of independent advisor. And we think that your mission to help millions of people in UK to manage their wealth in a better way really resonate with what we want to support as well. So that's a little bit the background on our thesis about Timeline. Obviously, like I won't go into details about the work we've done, but for us, it's also fundamentally a partnership going forward. As I said before, we are in this for the long run, and so being able to work with the management team, with yourself, and the rest of your C-suites and existing investor is also key for us. So like the team took also like a very strong importance in terms of our decision making.
I mean, thank you, Loic. And it's great to hear you say this. My general view, I mentioned earlier in my intro how there hasn't been, certainly in the UK, a lot of venture investing, and I have been. This will be, I think, officially maybe like the third funding round, if I count all the angels rounds as one, but they're not, right? But like I've been on this journey trying to raise capital for business, so there hasn't been, certainly in the UK, and even when I look across the pond in the US, a lot of venture investing into backing financial advisors. So and look, even in this last round, I spoke to over 50 VC firms. The round before that, probably even more, 70 different firms. And it was really, I mean, it becomes easier, but it was really hard when we started out to find VCs who would even back, a business like ours, supporting and backing financial advisors ultimately. And my view is that in the last decade, the 2000s, venture capitals, capitalists took a bet against the human advisor by backing robo advice. And now I believe that's failed. Not only have robo advisors not make, which is a wrong phrase. They're neither robots nor advisors. But let's not belabor that point. But my point is that not only haven't they made any dent to the human financial advisors proposition, they haven't actually made a significant dent, in my view, to serving people who can't afford or who don't want human advisors. And
Mm-hmm.
so, but I think there is interest in backing technology companies that are serving human advisors now. I mean, what's your assessment? Do you disagree with my
I,
thought in any way? And then I can give you your money back and say I don't want it anymore. I'm joking.
I would, in that case, I would say that I agree with you, Abraham, partially because I think on the robo advisors, I think the jury is still out.
Right.
If you look at the very bottom end of the retail market, I think it's very difficult for advisors to make the case and spend time around managing small portfolios, right?
I agree.
So
Yes.
in that case, I think technology can really help, and I think it goes hand in hand with the rise of passive investing. And I'm pretty sure that in the next few years, we're going to see a lot of people trying it again, especially with the emergence of generative AI, in order to build maybe a better user experience or user interface in the way that these robots interact with clients. Where you're totally right, it's true that we have not seen despite billions poured from VC firms, we haven't seen a shift of existing client portfolios towards robo advisors.
Mm,
Um,
mm,
but when I'm saying that the jury is still out is because I think wealth management is also a bit of a slow moving industry. It
yeah.
takes time to build trust, to change people's habits. I think as we speak, we have a new generation growing up with their phones in their pocket all the time, which will be more and more at ease with dealing with their money and with automated tools to manage their wealth also in the future. But again, I think this is maybe more specific to a certain segment of the market, which is more like the retail side of things, and certainly for the clients which are targeted today by independent advisors. We don't see the robots making a dent in the near to medium term. So
It's a yeah,
you're safe.
it's
Yeah.
yeah. Well, financial advisors are safe. Yeah, no. It's well, I like your optimism by when you said the jury is out. You have to be optimistic to be a VC, don't you? You have to be an eternal optimist. But actually, you know, as you were talking, I was thinking of examples. You have firms like Moneybox recently who've now said that they are now profitable. So actually, maybe there is something in this sort of direct to consumer proposition. But oh boy, does it consume capital? Like this business is born, um, you know, 80, 100 million. I know, um, Nutmeg did just to get to break even point. It's capital intensive,
Mm-hmm.
and as you said, it's a slow moving. I mean, one of the arguments was that, well, if you are providing technology for 18, 20 something year olds, they're going to have the wealth of the future. Well, you're going to be waiting a long time for them to come good. But
Absolutely.
as you said, uh, you know, it's slow moving and the jury's out. So I'll take that.
Absolutely. And it's funny actually that you mentioned nutmeg, because if I'm correct, I've seen them also providing financial advice on top of their
Yeah,
robot proposition. So it's clearly
yeah.
that they feel that it's something necessary in order to be able to serve best their client interests.
Yeah, they used to say, I mean, like the slogan in the industry used to be human advisors or financial advisors need robots. They need robo advice. They need to bring some sort of robo into their businesses. I remember writing an article, I believe in 2018, maybe 19, that inverted that and says, robo advisors need human advisor. And what you saw around that time is the likes of Nutmeg in the US, even the other ones, actually hiring human advisors and bringing that into their proposition. Again, I don't think that that is being an outstanding success, but we'll continue to watch that space. Yeah, but moving on. Look, I know you're a busy man, and you got other things to do. So let me start to wind this down. What are you seeing in the venture market right now? Are we going through some sort of winter in the venture market? Talk to me about what you're seeing in terms of valuation, behavior of venture funds, risk. Are they deploying? What are you overall? What are you seeing in the marketplace right now?
Yeah, yeah. So a few things. So I mean, first, it's clear there's been a slowdown compared to 2021. That's for sure.
Mm,
I mean, we all know that in the era of like 0% interest rate,
yeah.
capital was very cheap. So I think there was a lot of misallocation of resources in certain segments or businesses which don't make sense once rates are back up to the long-term level. And I think also people made a bit of mistakes in allocating too much capital and then in assigning too much value to companies which did not have any unique or scalable technology proposition. So I think we are a bit still in that reset phase at the moment, where things like unit economics, profitability again start to matter. And I think in fintech specifically, we've seen investors like really going away from undifferentiated B2C proposition, going away from balance sheet driven business models. And that really reinforced our view that our strategy has been the right one from the beginning. But I don't expect at the same time that this winter in where we are now will last too long, because the economy always goes in cycle. Yes, now it's not very good, for most people in UK or across Europe, but things will get better. I'm pretty sure about that. And humans simply they like to innovate. And I think venture and venture capitalists, as you said, we are optimistic. It's about investing and backing the innovators, and I would be very cautious in betting against the venture capital industry over the long term, because I think I'm quite optimistic that people will innovate and will want to break things and bring on new proposition to the market. Um, Again, you talked about the valuation. What we are seeing at the moment is a clear distinctions between, on one side, the businesses that don't meet the criteria of investors
Right.
in terms of risk profile or business segments they're in. So these companies at the moment, they're just struggling to raise funds, no matter the valuation. It's not a matter of price. It's really they are not in the segment that investors want to invest in. On the other hand, you have high quality businesses, fast growing companies, which are still attracting very, very high multiples. So I think what we see at BlackFin is that we have to stay consistent with our strategy. And by the way, we have not changed since we started. We continue to look for B2B capital-light businesses. We want to see a business which is built on scalable models using technology as a differentiator. We want to see sound unit economics. So it's not about growth at all costs. There needs to be like a clear path to profitability.
Good stuff. And you're in a great shape. In the sense that you're now deploying at the very early stage of deploying your second fund, and I assume you're going to do that over the next, I don't know. I mean, what is the life cycle of this thing? So you would deploy over a 3-year period, and then expect roughly 5 to 7 years in terms of exit. Give us a sense of the life cycle
Yeah.
of the fund?
Yeah, it's you're correct. So usually, like a PE or VC fund, they have a life cycle of about 10 years. So the initial investment phase, as you said, is between 3 to 5 years, and then the phase 2 is about managing the portfolio and also coming to an exit for certain companies. So yeah, you spend the first 3 to 5 years making new investment, and then you spend the rest of your time working closely with the portfolio of companies to help them grow, add value, and ultimately looking to sell your stake, or exit these companies. So all in all, like the funds have like maturities of about 10 years, can be extended sometimes by 1 or 2 years supplementary. And so when we ourselves make an investment in a company, it means that usually we would stay for roughly 5 to 7 years in total before we work with the funding team and other investors to see if there's a possibility to exit. And when we talk about exit, I mean, there's few options. It's not like one size fits all. Because a VC fund could find simply like another VC fund to which we could sell our stake. So it's quite common these days, and I think it's going to become more and more common as some investors specialize in this sort of transactions. Another option, obviously, could be to sell the entire business. Obviously, if everybody at the table is agreed to that, you could sell like the entirety of the business to someone else, like a trade buyer or another financial player who will buy the majority. Third option could be an IPO if the company fits the size and criteria to be public. So there's the exit could take like many different shapes.
Good stuff. Good stuff. Like it's been, it's been good talking to you and learning from you. Do you have any parting words? Anything else that you wanted to talk about, or that you wanted our audience to know?
No, I think it was very nice to talk to you, Abraham. I hope your audience also have enjoyed the show, and obviously for everyone interested in reaching out to us, they can find us on our website, BlackFin.com or BlackFin-tech.com, and more than happy to have a discussion with anyone on.
Good stuff. If you're a founder or fintech business looking for capital, go find Loic and talk to him. No, like it's been good having you on the show. Thank you for your time. Thank you for your wisdom, and yeah, just thank you. It's been wonderful. Thank you very much.
Thank you very much, Abraham.
That's a wrap on today's show. Massive thanks to my production crew, especially Jake Osha, Melissa Canham, and the entire team. And of course, to our sponsor, Timeline, the market-leading provider of integrated planning technology and model portfolio service to advisors. I do hope you've enjoyed today's show. Head over to Apple Podcast and give us your review there. Until next time, goodbye.